Hello and welcome back, options traders. Well, a good question for the group. I like to pose these every once in a while, make people think and understand more of the intricate properties of options. And so for today, can you flip Gamma and Vega? So for those traders who are familiar with these terms, they're just sensitivity measures. Normally Gamma and Vega move in the same direction. But the question we want to ask is, can you flip them? Can you make one go up and the other go down? Now, most traders will say no, because they're joined at the hip. But if you understand your options theory, and your strategies, you'll see that just about anything is possible. So, can you flip Gamma and Vega? And if so, how do you do it? Well, again, just for a little background, remember that Gamma is one of our Greeks, and it shows the sensitivity of our delta to changes in the stock's price. So what it's saying is that if the stock's price rises by $1, what's that going to do for our delta? Is it going to move it from 50 to 52 or from 50 to 60? And in order to find out what that change is, we look at Gamma. Now, Vega is another one of the Greeks, and it shows the sensitivity of an option's price to changes in volatility. So if volatility goes from 20% to 21%, that's an increase, what we call a one-tick increase, or a 1 percentage point increase in volatility. What's that going to do to your options price? Is it going to move from $3 to $3.10 or from $3 to $3.50? That's what Vega shows us. And so, again, normally Gamma and Vega will have the same sign. And this is why a lot of traders will say, no, you can't flip them. So what do I mean by that? Let's take a look at a long call. And here's our graph at expiration, our hockey stick graph in blue, buying the 100 call, there's our strike. So we have positive deltas. We want the stock to move. That's what the graph is showing us. The higher the stock price moves, the more money we make. It's a very bullish position. And we can also see our current graph right here in red is showing that we will start adding to our deltas. So we've got very low deltas down in here, almost zero down here on the far left. But if the stock price starts to move, look at the slope of that red line. It starts going from very flat to getting almost vertical, like the blue line right out here. That's showing that we are adding deltas to our position. It likes it when the stock price rises, and that is from positive Gamma. Positive Gamma means that the position is, in this case, manufacturing more positive deltas if the stock price moves in your favor, which is a good thing, but it's also subtracting them if it moves against you. So instead of having very high deltas, if the stock is instead falling, this red line is starting to get flatter. We're becoming less sensitive to falling prices. So yeah, that's a very nice property to have, and that's why you have to pay for long options. Now also, because we want this stock price to move, we are going to benefit from having an increase in volatility. And that's why long options are positive Vega. So think about it. If volatility goes from 20% to 40% or 50, 60%, that's great for us because we can only lose so much to the downside. But the better the chances are that we can get some gains, bring it on. We'd love to see volatility spike. It can't hurt us, but it can certainly help us. So a long option will have positive Vega, and from what we've seen so far, we'll also have positive Gamma. What about a long put? Same thing, just in a different direction. So the put option has negative deltas. This line is leaning up here to the left, but if you look at the red line, kind of a little bit of a smile, which I've talked about before, that's also positive Gamma. And that's just showing that as the stock price falls, we're becoming more negative. It's selling more shares into a falling market for us. And that's why this red line is getting very close to parallel to this blue line if the stock price falls far enough. But if the stock price rises, look what happens. This red line starts to flatten out. And the reason for that is the position is automatically adding deltas to our position. It's preventing these risks to the upside of a short position from getting too big. So again, that's a great feature of a long put, and that's why we have to pay for it. So with a long put, we have negative deltas, but we have positive gamma and we have positive Vega. Because just like for the calls, the more volatility there is, the better the chance for a big downward move. But if it turns out to be to the upside, not really going to harm us. But what happens if we sell options? Shouldn't we get the opposite effects? Absolutely. Short call, look what happens. If the stock price rises, deltas are becoming negative. Stock price falls are becoming closer to zero. So now you can see that you don't want the stock to move. You would love to just have it sit still. And that's why this red line is now more like a frown. It's curving downwards. That's negative gamma. It's telling us that we really don't want the stock price to move. And that's going to be the best thing for us. So if we have negative gamma, we really want a neutral outlook. But what type of Vega do we have? Well, we're short an option. If we just said we don't want it to move, we don't want volatility to increase. That's going to be bad for us. We really want things to sit still. Short put, same idea, different direction. Look at the red line, curving down, that's negative gamma. That's again telling us that we would prefer to have this position sit still. We want the stock to just stay solid, stuck in the mud right here at the strike. Because if it goes up, we're losing deltas. If it comes down, we're actually gaining deltas, but that's a bad thing in a falling market. So if we don't want the stock to move and volatility increases, that's also going to be bad for us. Because an increase in volatility is just the opposite. It's saying, yes, we are expecting bigger moves. So short puts are going to have negative Vega. That means that their positions are going to lose money if volatility spikes. Volatility up, position value down. That's what negative Vega means. So the thing is, if you talk to most traders, they'll say, well, gamma and Vega obviously are joined at the hip. If we want the stock price to move, obviously we've got positive Vega. If we don't want it to move, we've got negative Vega. You can't separate them. Well, is that really true? So the question we want to look at in this video is, can you flip them? Can we make them go in opposite directions? And the answer is yes, but you have to use different expirations. This is one of the reasons, certainly not the only reason, for a lot of the more, I don't want to say exotic strategies, but the strategies that most people aren't too familiar with, especially if they're starting out. And this is one of the reasons that we'll use such strategies. So for instance, longer dated options have a higher Vega. And that's because if volatility goes from 20 to 30%, an option that expires tomorrow isn't really going to be affected. There's not enough time for it to do anything. But if you have a 1-year option, that's a different story. That option's value is going to pick up a lot of that change in that volatility. So all things being equal, longer dated options will have higher Vegas. So if you buy longer dated options, you're going to get greater amounts of Vega. All options that you purchase will certainly have positive Vega, but it's going to be a lot bigger and a lot more pronounced on the longer end of the expiration curve. So what you could do is you could buy a longer dated option, get this, loaded up with this greater amounts of Vega, but you could sell a shorter dated one, and that could also create negative gamma. So look what happens now. We're getting positive Vega and we're getting negative gamma. So this is where you get into strategies like diagonal spreads, double diagonals, calendar spreads, double calendars. These are all a certain family of strategies where you're going to be buying and selling different expirations and or possibly different strikes. But the key is that you've got different expirations, and that's what's allowing you to flip these. So for instance, let's take a look at a double diagonal. Maybe you buy a 3-month $95 put, and you sell a shorter term, maybe a 1-week $100 put, and then sell a 1-week 105 call, and then buy a 3-month 110 call. Now there's a number of ways that we can view this strategy, and it's one of the things that makes this strategy so interesting because there's a lot of potential morphs. But take a look at the 2 legs in green. Same expiration, you're buying a put and a call, different strikes. That's a long strangle. Now look at the one in the center. Same expiration, Selling a call and a put, different strikes. That's a short strangle. So one way to view a double diagonal is that you are buying a longer dated strangle and then selling shorter dated strangles from within it. Same idea as just buying a call and selling a call, you're just doing it with strangles. We could also buy a strangle and sell straddles. It's sometimes called a straddle-strangle swap. Same ideas, but one of the things that I'm really trying to show you here is that you can flip your gammas and vegas. So if we did this double diagonal spread, this is the expiration graph, at least of the shorter term option in blue, and here's our current graph in red. So what's happening here? Well, if you look at the red curve, the current curve, it is sloping downwards like a frown, so it's negative gamma. That was the first piece of the puzzle. However, if we get a spike in volatility, the value of the position is going to rise because we own longer dated options. Now, the one thing that you have to be careful of here is that's not necessarily a good thing for the strategy because ultimately we do want it to sit still. And if volatility is spiking, it's really not an ideal thing. But if we need to close it, at least we can do it at a profit because we own the longer dated options. So that's just something to think about for traders who have wondered about all of the different strategies and why they're so important to understand. There's a lot of fabulous opportunities in the market, and everybody's different. It depends on the risks you're willing to take and the rewards you're after. But if you really want to get good at it and to customize them, you need to understand your options. So for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new technical analysis course, all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.